So, one of the very valid criticisms of the Federal Reserve, where I worked for nearly a decade, is that they're looking at very lagged data that really is backward looking, as opposed to trying to pay closer attention to some of the especially rich real time economic data that we have in hand. Right now, unfortunately, it feels like the Fed is pretty much what we call behind the curve. So they should be lowering interest rates, and yet because they're driving using the rearview mirror, they're late to the game. This is yet another signpost for Jay Powell to say, why is the Bank of Canada lowering interest rates? Why is the European Central Bank lowering interest? Is the United States an island? Has it ever been? No. And so it's very much a red flag that we are not more in sync with other countries, especially when what we call the soft survey data are signaling to the Fed that they're really not listening to what's happening on the ground. The University of Michigan has data back to 1968. It tends to be the case when 50% or more Americans are queried and they say, in the next 12 months, I see the unemployment rate rising. So once we cross that 50% line, historically speaking, we're already in recession. Now, the University of Michigan's question has been answered in the affirmative by 64%, 65, 66% of individuals in the last few months saying, I expect the unemployment rate to be rising in the next 12 months.